So my first stock pick for January 2026 is Tiger. It's a up fintech. And just to reiterate the moving averages, we are going to look at the candlesticks, and this is the monthly chart, and we are looking at 7-month moving average, 21-month moving average, and 50-month moving average. So first, some quick facts about this stock. You can trade US, Hong Kong, Singapore, and Australian markets using one account. Then they have the Tiger. They have introduced the Tiger AI, which is first of its kind AI assistant for real time stock analysis and news. This is a licensed broker heavily regulated by major authorities like Singapore, and it's a crypto hub integrated spot trading for digital assets in select global regions. And Tech First is roughly 50% of the staff are dedicated solely to R&D and platform innovation. So they are innovating a lot. If you look at the financials look amazing. So let's look at the annual one. So they had the 391 million in 2024. Before that, 272 million. But overall, look at the growth from previous years, 136%, 90%. Then there was a down, 2022, 20%. So it's double digit growth. And they are operating. Look at the growth of the operating incomes. They look at the growth of their net incomes, which is amazing. They are already profitable company. If you look at the balance sheet, let's look at the debt to asset ratio, 89% debt to asset, and you would think that is very concerning. But if you look at the details of the balance sheet, if I go here and look at the balance sheet, is total assets 2024 was 6.33 billion, and liabilities 5.73 billion, and current liabilities of that is 5.576 billion. So it's not capital expenditure liabilities where they have a lot of debt to the banks. Is like liabilities, accounts payable liabilities, right? So with liabilities with the vendors, which so I would say this is common for high growth companies. They have a huge account receivable from guests and account payable to vendors and stuff. So it's not a significant investment liability like companies like CoreWeave, right? So let's go to cash flow, and then if we look at the cash flow, and let's look at a view, they were negative in the previous year, in 2023, but they are very much cash positive, and look at the growth of the cash positives, right? So and then if you look at the PE of up fintech, we will see its PE is only 12, so it's not a high PE at all. So after looking at the financials, you can see from these charts, we have the 7-month, 21, and 50-month moving average, right? So it was down significantly for quite a few months. If we look at, it was down from 2021, and now very recently. So I would say in 2024 December last year, it crossed the 7-month, 21-month, and now is a growth in a growth projection. So it went up to 12 in September. Then it fell down again to December, in December at 8.37%. But you can clearly see, you can project that it's going to grow until it reaches a reasonable PE. So I would say it should grow by the end of 2026 if the growth holds. And now the last day it closed at 10.44. I would say it can easily reach 12.5 by the end of 2026. The next company is Block Inc. Let's quickly go over blocking. So it's a brand umbrella. So it's a parent company of Square, the online payment system, Cash App, Afterpay, and Tidal. So these are big names. You have already heard the names. It has the integrated voice and chat AI that automates orders and staff scheduling for businesses. Cash App Banking features Cash App Green, a rewards tier with free overdrafts, and then Bitcoin First developing its own hardware, a BitKey wallet, and Proto Money. Very gearing up for the future, I guess, and fully integrated after paying the Cash App service. So these are big brands and these are growing brands. And if you look at the financials, and let's go to the total. By the way, I'm using the Webull software, guys. I This is not sponsored, but I love this software. I use Webull in PC. I use Webull in the in my phone. So any type of analyzing I'm doing, I'm using Webull. Try it out if you want to do analysis. So if you look at the total revenue, look at the growths of total revenue. Last 2 years, 10% and 25%. Operating income positive, and look at the growth. It was negative before, but look, now it's positive. It's net income positive. It's a profitable company. Look at the growth of this, right? So it was going down, but it's significantly up. Then if you look at the balance sheet, it's debt to asset ratio 42%, not significantly high. It should stay around 50%, 50-60%, I guess it's okay. And then cash flow, it's 1.71 billion positive cash flow, right? And then we are looking at, like, that's operating cash flow, and then we have the investing cash flow, financing cash flow. So all the cash flows are positive. And then if you look at the comparison, its PE is only 13, so which is very good. It's a low PE. So if you look at this, when it dropped, went to 273 during the pandemic, and then significantly dropped to 52 on in September 2022, and now it's hovering around 68. So last close was 65. But the situation is not like 3-4 years ago, right? It's not the app, the whole platform is not like 2022 anymore. And you can see that keeps hitting the averages, right? It went up to the 21 week, fell down, went up to the 21 month, and then went up to the 50-month moving average and went down. It hit 50-month moving average and went down and lost momentum. So very likely is going to cross this 50-month again and start going up. And look at the range, look at the difference. So when it's 65 now, now, right? So when it goes up, look at where 50-month moving, it's 80. 65 to 80 is pretty good return, and and that will be the start of the growth. You don't know how much it will start growing, right? Even maybe go to 100, in the next few years. But let's set up a target. Let's set up by the end of 2026. Let's assume it will be at 75. The next stock is Vicky Properties. Before discussing the chart, let's read the notes. It's a Vegas powerhouse, the largest landowner on the Las Vegas Strip, owning icons like Caesar's Palace, MGM Grand, and Venetian. I saw Caesar's Palace and Venetian last year. It's pretty amazing, guys. I didn't know that Vicky Properties owns these iconic hotels. A pure landlord, a REIT that owns the real estate but does not operate the casinos. Inflation hedge most of its long-term leases, some 40 plus years, include escalators that automatically increase rent based on CPI, which is amazing. 100% occupancy, maintains a perfect occupancy rate across its 90 plus properties thanks to its high demand and specialized assets. So this is pretty big. And Vicky is a Latin word. I was doing research and found out it means I conquered. So they are conquering, not so much in chart though. So if you look at the chart, um, um, and go back to 2017, you will see that it's every month it has a clear growth pattern, first of all. And then when it goes down and touches the 50 month, it goes up again, and pandemic happened, so it went significantly down. But it went up again and then went down and touched the 21-month moving average, went down again, touched the 21 50-month moving average, went up again, and finally now it's in 20 um, it's in 50-month moving average line, right? So you can see that it's touching this, and it has lost the momentum. You can see that it's negative. The yellow means it has, like, it the close less than it opened, but last 2 months you can see that it has lost the momentum. So most likely it will start growing again. And so last month it closed at 28, right? And then if you look at the financials, this is, let's look at total revenue. Look at the growth, year over year growths. Didn't grow much in 2024, but look at the growth in previous years. Net income is profitable, 2.72 billion in profit, but look at the growth of last 5 years. Operating income, double digit growth in most of the 4 of the 5 years. If you look at the balance sheet, it debt to asset ratio is 40% only, which is good, closer to 50%. Is cash flow, its operating cash flow is positive, its investing cash flow is negative, and also finances, so not so good about from cash flow, I guess, because they're a property company. And if you look at the PE ratio, its PE is now only 10, close to Uber's. Remember, we discussed Uber last week. So just if you look at all the KPIs or parameters together, except for this financing, most of it is positive year in terms of year over year growth. So that is very good. I think it's going to go up. Let's set up target 32 for the end of 2026. Our last stock for this month, for episode 2 of this series, is Hess Midstream. First, let's look at the notes. It owns the specialist pipelines and processing plants for oil and gas in North Dakota's Bakken region, and primarily services Chevron, providing a very stable and long-term customer base. Revenue comes from fixed fees for moving and storing products, protecting it from volatile oil price swings. It has a fee-based model and famous for high yield payout. So it's a dividend first company and infrastructure lean. Most major construction is complete, allowing the company to spend less on building, more on returning cash to investors. So cash is an important factor for this company. If we look at this chart, which starting, let's go back for even further. Let's start here. 2017. In 2017, it hovered for a long time around this, around 11, since 2020. Then it exploded from 2023, right? So it went up to 25, then again down to 20, and started going up, all the way up to 42. And then there was, I guess it missed the payment, or I don't know, there was big drop. It significantly dropped, lost some downward momentum. It's trying to get back up again to 30. For the last 4 months, it's hovering around this price range, like 30, 33, 34. So we might see a drop even further. This could, if it drops, it may drop to 29, 30, or it may continue after this drop. It may continue to go up even further. Um, so let's look at the financials. First, let's start with income statement. Its revenue is growing. Last year it grew double digit. Its balance sheet, its debt to asset is significantly high, 88%. And if you look at the statement, It has total liabilities of 3.69 billion, and of that, the non-current or long-term debt was 3.45 million. See, it's not like Tiger where it's just long, mostly due to vendors. It's not like that. So these are long-term loans, interest-bearing loans. So this is one concerning point, but it's a energy company, oil and gas company, so they had to take loan to build the infrastructure. So I understand that. Is cash flow, operating cash flow is positive and it's growing. Its investing cash flow is significantly negative. Its financing is also it has improved. It's negative, but it has improved from previous year. So if you go to the breakdown, you can see the net change in cash is barely improved. There was a negative 1 million. The previous year was 2.3 million. So liquidity is an issue for this. That's why it's the least favorite of these four. But it has a lot of it's a growth focused energy company, and if you look at the PE, its PE is only at 12. And guys, this is not financial advice. So we are just discussing stocks. Like, please use your own discretion when choosing a stock. I'm not investing in all the stocks. Maybe I'll invest in one or two, but these are the ones that I'm looking at right now. So I put the stocks here. Tiger last close was 10. We are our end of 2026 target is 12.5. XYZ end of year is 75. VC properties target is 32, and then his midstream is 39. So most of these has 12 to 19% of gain. That's the target we're set up. These are the stocks from the last video. You can see in 1 month we got some gains in Novo Nordisk. We have some gain in Uber. We have a big loss in Infosys, and NCLH and CCL are hovering around the same price. So it doesn't really matter. We have a 30-year window for investing, right? It's a very long investing. So even if it doesn't make the price this year, maybe we can look at next year. It doesn't really matter as long as we can make logical investment decision. I think we should be good in a long time frame. Thank you for watching, guys. Hope this video helped you. I'll see you in episode 3 next month.